Now let's be honest, when you think about retirement, the word taxes doesn't exactly make you smile. You're thinking about freedom, about travel, about spending time with your family, or finally doing the things you've been putting off for years. But here's the truth. When your paycheck stops, your taxes don't stop with it. They just change shape. And understanding how that change works, what gets taxed, what doesn't, and how to plan around it can make an incredible difference in how long your money lasts and how much confidence you have in retirement. So today, I want to walk you through a complete, practical guide to retirement taxes, built around a client story that will follow all the way through. And at the end of the video, I'll share how you can request a free video review of your own retirement tax situation. Hi, I'm Josh Palmer, Director of Financial Planning with the Noble Group. I'm a certified financial planner with more than 25 years of experience in the financial industry. David and Megan are both 67 years old. They just retired this year. They did a great job saving between their 401ks, IRAs, and brokerage accounts. They've built up about $2.5 million in total savings. David worked for an engineering firm for 35 years, and Megan spent her career as a high school counselor. They're ready to enjoy retirement, travel a little, and spend time with their grandkids. Here's their financial snapshot. About $1.8 million of that money is in pre-tax retirement accounts, IRAs and 401ks. Around $400,000 is in a Roth IRA that's already tax-free, and another $300,000 is in a regular brokerage account that they've built up over time. They're both starting Social Security this year, and together that's going to bring in about $69,000 per year before taxes. Their question for us was simple but important. How do we turn what we've saved into reliable income and not lose too much to taxes? When you're working, taxes are fairly straightforward. You earn a paycheck, your employer withholds taxes, and you file your return and you're done. In retirement though, your income starts coming from several different sources, and every source gets taxed differently. You might have Social Security, pre-tax IRAs, Roth IRAs, brokerage accounts, maybe even a pension or part-time income. That variety can be a blessing and a curse. If you pull from the wrong account at the wrong time, you could end up paying thousands more in taxes than necessary. But if you understand how to sequence your income, you can stretch your money much farther and create more flexibility in your plan. I call this tax diversification, making sure your assets are balanced across taxable, tax-deferred, and tax-free accounts so you can manage your income strategically every year. Now, the 5 years before and after retirement are what I call the tax sweet spot. You've likely stopped working, so your income is lower, but you're not yet required to take money out of your IRAs. That window creates a lot of opportunity. In David and Megan's case, their goal was to spend about $150,000 a year before taxes, enough to cover their lifestyle, healthcare, and some travel. So the first step was to figure out where that income should come from. We started with their brokerage account. That's their taxable money, money that's already been taxed once when they earned it, so pulling from it again doesn't create much new tax. It's just long-term capital gains. By drawing from that account in the first couple of years, we were able to give them income while keeping their overall taxable income low. That let us take advantage of the 0% long-term capital gains bracket. Yes, 0%, which meant they could sell appreciated investments and pay little to no tax on the gains. This approach gave them the freedom to let their IRAs potentially grow while avoiding a spike in their tax bill early on. After the first 2 years, we started to slowly introduce IRA withdrawals. This is where planning gets interesting. Pulling from an IRA adds ordinary taxable income, but it also affects how much of your Social Security is taxed. You might not realize this, but up to 85% of your Social Security benefits can be taxable, depending on what's called your provisional income. That includes your adjusted gross income, plus half of your Social Security, plus any tax-free interest. For David and Megan, we modeled different scenarios using our financial planning software. If we took too much from their IRAs too quickly, their Social Security benefits would become almost fully taxable, and it would push them into the next tax bracket. So instead, we built a blended income strategy. We pulled part of their income from IRAs, part from taxable accounts, and the rest from their Roth. That balance kept their total taxable income under the next bracket threshold, reduced how much of their Social Security was taxable, and lowered their effective tax rate to around 12%. That's the beauty of tax sequencing, not guessing, but designing the order that keeps more money in your pocket. Speaking on Social Security, this is an area where many retirees get blindsided. If you earn too much income from other sources like IRA withdrawals, you can trigger what's called the tax torpedo. That's where your additional income causes more of your Social Security to become taxable, creating a snowball effect of higher taxes. We made sure David and Megan avoided that trap. By blending their withdrawals, part taxable, part tax-free, we kept their provisional income under that level that triggers maximum taxation. That one adjustment alone can save retirees tens of thousands of dollars over time. Now let's talk about one of the most powerful tools in retirement tax planning, the Roth conversion. David and Megan retired at 67, and they don't have to start required minimum distributions or RMDs until age 73. That gives us 6 years of flexibility. Those 6 years are golden. Their income is moderate, their tax bracket is low, and they can move some money from their traditional IRAs into Roth accounts while paying taxes at a controlled rate. In their case, we looked at converting about $70,000 per year. That kept them in the 22% bracket, avoided bumping up their Medicare premiums, and slowly built up their Roth balance over time. By age 73, they would have moved roughly $400,000 into Roth accounts. That means $400,000 that will now be able to potentially grow tax-free for the rest of their lives and for their heirs later on. This strategy also reduced the size of their future RMDs, which keeps their future taxable income lower and helps them avoid what we call the tax creep. That gradual climb into higher tax brackets as your pre-tax accounts keep growing. Once David and Megan reach age 73, the IRS will require them to start taking money out of their IRAs, whether they need it or not. This is where many retirees get caught off guard. Those RMDs are fully taxable as ordinary income, and they can push you into a higher tax bracket or even cause you to pay more in Medicare through IRMA surcharges. Because we started their Roth conversions early, David and Megan's RMDs are now smaller and much more manageable. Instead of being forced to take out $100,000 or more each year, they'll be taking closer to $62,000. And that's a big difference when you're trying to manage taxes and avoid crossing key income thresholds. And since they'll have a healthy Roth balance by then, they'll also have tax-free money they can use for big expenses, travel or healthcare needs without worrying about bumping up their tax bill. Now, David and Megan are also very involved with their church and a few charities they've supported for years. One of the things we talked about is how to make their giving more tax efficient. Once they reach RMD age, they can use something called a Qualified Charitable Distribution, or QCD. It lets them donate directly from their IRA, up to $108,000 in 2025, to a qualified charity. Here's the key. That donation counts towards their RMD, but doesn't count as taxable income. So they can give in a meaningful way, satisfy the IRS requirement, and reduce their overall tax exposure all in one move. That's what I call tax-smart generosity. Another layer to think about is where you live. David and Megan live in Texas, which has no state income tax, and that's great for retirees. But if you live in a high tax state like California or New York, those state taxes can add up quickly. Sometimes simply moving to a tax-friendly state can free up thousands of dollars a year in extra income. It's not always the right decision for everyone, but it's worth factoring in as a part of your overall plan. Eventually, we must also think about what happens after you're gone. Under current law, if David and Megan's kids inherit their IRAs, they'll have to empty those accounts within 10 years and pay taxes on those withdrawals. That can be a huge hit, especially if the kids are in their prime earning years. But Roth accounts are different. Their children could take money from those Roth IRAs tax-free on their own schedule within that same 10-year window. By converting money to Roth now, David and Megan are essentially prepaying the taxes at lower rates and giving their children a much more tax-efficient inheritance later. That's smart legacy planning, not just leaving money, but leaving it the right way. Now let's step back for a moment. I know all of this can sound complicated. Brackets, conversions, RMDs, Medicare limits. It's a lot of moving parts. But when you see it mapped out visually year by year, it's not overwhelming, it's empowering. I'll never forget what David said during one of our meetings. He looked over at the financial plan on the screen and said, "You know what, Josh? I used to dread tax season. Now I actually understand where my money's going." That's the goal. Because good planning replaces fear with clarity. And when you can see your future, when you understand how income, investments, and taxes work together, retirement becomes less about guessing and more about confidence. So let's recap David and Megan's plan and how it could apply to you. We started by pulling early income from their taxable account, allowing their IRAs to keep growing while minimizing taxes. Next, we layered in a balanced withdrawal plan, part from IRAs, part from Roths, to keep their income steady and their effective tax rate low. We used Roth conversions strategically during their low tax years to build long-term tax-free growth potential. And we planned ahead for their RMDs, Medicare premiums, and charitable giving, so none of those things came as surprises. The result? A smoother, more tax-efficient retirement that gives them more control, less stress, and more money left over to enjoy. Taxes don't have to be scary, they just need to be managed. The difference between a good plan and a great one often comes down to how well you coordinate your taxes, not just in one year, but across your entire retirement. To see what this could look like for you, click the link in the description or scan the QR code on screen. After filling out our quick survey covering your unique financial situation, we'll record a free video filled with personalized recommendations. Our belief is simple. Clarity builds confidence, and confidence is what allows you to enjoy the retirement you've worked so hard for. Thanks for watching.